The MACD cross stands out as a straightforward signal for buying or selling. The primary strategy when using the MACD involves identifying a significant trend, and this can be confirmed by observing the two moving averages on the MACD chart below. The wider the gap between these moving averages, the more pronounced the trend. A robust trend enhances the effectiveness of the MACD. As the trend nears its conclusion, we witness the faster moving average crossing the slower one, signaling a buying opportunity. This often coincides with the bottom of the trend, marking the precise point of reversal for a new trend. The MACD excels at identifying reversals with a distinct and reliable signal. While there are various ways to utilize the MACD, the most common and accurate approach involves recognizing the crossover for informed trading decisions. Similar to another setup we've discussed, the moving average crossover, this approach is essentially identical. It involves observing two moving averages and how they interact. When the faster moving average is above the slower one, it indicates a bullish trend. Conversely, when the slower moving average is above the faster one, it signals a bearish trend. The effectiveness of this method is heightened in strong trends because it results in significant reversals. In situations where stocks make extreme movements, they are also likely to reverse in equally dramatic ways. This characteristic enhances the reliability of the strategy, making it particularly effective in capturing substantial market shifts. Indicators have a history of generating false signals. If you were to execute a trade every time these lines crossed, you'd likely end up with financial difficulties. It's crucial to understand that this is just one piece of evidence and should be used cautiously, considering all the right conditions. For instance, in a later section of the stock chart, the MACD nearly crosses and eventually does so shortly afterward. However, the reversal at that moment is feeble and wouldn't have resulted in significant returns compared to the risk involved. This is often because the near crossing weakened the potential downward move when it actually crossed later. This scenario is a common occurrence with the MACD, where the expectation of a perfect cross doesn't always materialize. It underscores the importance of being mindful and not relying solely on indicator signals for trading decisions. From a risk-to-reward perspective, it's prudent to trade only when there's a clear crossover in the MACD. Developing a stop-loss plan is crucial due to the historical tendency of the MACD to generate false signals. Here are some pro tips for using the MACD effectively. Bullish positions. Consider taking bullish positions only when the two moving averages are above the zero line, which is where the histogram flips. Bearish positions. Opt for bearish positions when the moving averages are below the zero line. Observing the chart above validates these tips, showing that the stock tends to move higher in a bullish trend when above the zero line and lower in a bearish trend when below the zero line. This underscores the importance of aligning trades with the position of the MACD relative to the zero line. The most favorable time for a long entry is when the MACD moving averages cross, with the fast moving average crossing above the slow one. Conversely, the optimal time for a short entry is when the MACD moving averages cross, with the slow moving average crossing above the fast one. These crossover points provide key signals for traders to make informed decisions on entering or exiting positions. Determining where to place the stop loss for the MACD can be challenging. However, as with other examples, a common approach is to position it a certain percentage below the entry point. The extent of risk undertaken by traders is entirely contingent on their individual assessment of potential profits. This emphasizes the importance of aligning risk and reward considerations based on personal trading strategies and goals. For long positions, the optimal time to take profit is when the MACD moving averages cross again, with the slow moving average crossing above the fast one. Conversely, for short positions, the best time to take profit is when the MACD moving averages cross again, with the fast moving average crossing above the slow one. These crossover points serve as key signals to capture profits and make strategic decisions for both long and short positions. Thank you for watching today's video. I hope you found the content valuable. If you have any questions or doubts related to trading, don't hesitate to reach out to me on WhatsApp at this number. If you enjoyed this video and want more insightful content on trading, make sure to hit that subscribe button and turn on notifications so you never miss an update. Your support is what keeps this channel going. I'll be back soon with another exciting trading topic. Until then, have a fantastic day, and may your trades be prosperous. Happy trading!